So
like crazy as well.
I'm enjoying the winter here.
Nice. Well, so do you, so wait, so you have said winter. We're live. It doesn't matter, but we're we're live. But okay, so you guys have winter and you're still outside doing things.
Yeah, I love the winter. It's like 12 degrees, 15 degrees Celsius. I don't know how much that is in Fahrenheit, but it's pretty cool. The
Hmm.
max it goes up to 21, 22, so you can be outdoors all day.
Does it snow at all there?
No.
Okay, so yeah, so you were telling me you were enjoying winter. I'm having a thought that okay, I'm thinking of snow and mountains, and I should have figured yes, you're in Dubai. Of course, it doesn't mean snow and mountains.
Yeah, although we do have snow inside the malls. So there are
Nice.
ski parks and all that inside malls where you can go learn skiing.
Oh,
A lot of
really? They
people
have
do
like
that.
indoor
Yeah,
skiing.
yeah,
Wow,
yeah,
that's
yeah,
interesting. Have you ever went
yeah.
skiing?
Nah.
You gotta try it. You gotta try it once, especially if it's an indoor one. I'm sure it's like a small, like pretty easy thing to learn on. You'd
Yeah,
like it. It's fun. It's fun to try at least. Like try it if you
yeah,
like it, do it. But it's a lot of people are afraid of getting hurt. They just don't get hurt. But
yeah.
anyways, we're live. We're talking about snow. We're talking about Dubai. We just got hit with a bunch of. We're getting that Arctic blast that's coming through the United States at the moment. Um, which gave a big boost to natural gas prices, which are down quite a bit today. What did they get down? Seven. I saw 7% was the last time I looked. Could be down even more at the moment. But we're seeing a lot of the commodities are really holding up really well. I think one thing that was an interesting thing I shared with my subscribers this week, which was if you look at futures, you're seeing natural gas has been like year over the last year, it was up like 76% or something crazy. And then you got oil just over the last month, which was very interesting to me considering the stock market was under a lot of pressure, which I wouldn't have thought that would happen in December, which it does happen from time to time. And I think something that you have to think of when you see seasonals work against itself is what could possibly be ahead. For example, natural gas, the seasonality for natural gas in November, December is pretty bad. Natural gas was raging higher. That's usually saying that that's a sustained trend. So what does it mean if the S&P 500 is kind of weak in a very strong seasonal period of time? So that's something to also think about that we could talk about a little bit today. But I want to talk to Kashap a little bit about last year. We had as a fund, we had a really good last year. We were up 70, just over 70%, just barely over 70%. So it was really good for futures. The ETF portfolio is up over 30%. So we had a really nice year, very solid returns. But things that happened that actually, I wanted to talk to Kashap about, which he had the idea at the beginning of this year. I was like, there's no way the Fed can start to lower rates. And once again, as a trader, when you say things like no way, you should just fade yourself because obviously something's wrong with you if you're saying there's no way. There's no 100% probabilities in trading. But something that you and I had talked about at that time, which was, hey, the Fed is probably going to cut rates this year. And this is when nobody was talking about that. Everybody kind of was in the camp of either they were going to hold them flat. Some people were actually talking about raising rates in a lot of the analyst fields. I was just thinking that they were not that stupid to start lowering rates right now, with the market just raging the way it is. Obviously, I should know better. The Fed always does very stupid things. So I want to go back to you. Kashap changed my mind on that. We had a good trade because of that. So I want to also ask Kashap, what were you seeing around that time? What made you think that the Fed was going to start lowering rates?
So this was, I think the conversation was back in April, and I had put out a call saying I'm long bonds and that it was a time to get long bonds across the curve, but I'm going to do the 2 year because it's the easiest and the safest. And everyone talks about how bonds had a really tough 2024, whereas for me, my bond trade was the best futures trade of the entire year. And that was just because of the timing. So I looked at the COT, I looked at the positioning, and I had this thinking that the Fed is going to lower rates, and all of it just came together, and I had a excellent trade in bonds. I think I was long from April all the way to September, had a really good run. exited because it kind of became a consensus. So this was right before the first Fed cut. And that was the time the bond trade became consensus. And then they cut 50 basis points and yields shot up. So it seems very counterintuitive to everyone that the Fed cuts. So I think the first 100 basis points of cuts led to a 100 basis points hike in the 10-year yield or something like that. And everyone's like, how can that happen? How can that happen? Well, it happens because positioning got way overcrowded ahead of the first cut. So when they cut, it was just positioning getting reversed. And also because you have to understand that the Fed cut for political reasons. Like you cut right before the election, that too massively, that has only one implication. Now you can say you're not political and all that, but you cut so massively, and then when someone asks whether you step down if you get fired and you come and say no, those are very political statements. So the Fed is being political here. And anyway, we're getting off track. But the point is, I had a really good trade in bonds, and that was just because of not going contrarian per se, just looking at positioning, just looking at a few factors, and realizing the Fed is going to cut. Now, here comes the interesting part. What will the Fed do in 2025? So, Fed clearly, especially it's obvious Powell doesn't like Trump, and it's the feeling is mutual. So, what happens now? Is the Fed going to? So usually when you have a rate cutting cycle, it goes rate cut, rate cut, rate cut, and it just keeps going until they get to whatever they think is neutral. So this is the first time where we are going to have a Fed that goes cut, 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 maybe hike, maybe pause, maybe hike, something of that sort. So meaning they're going to interrupt the rate cut cycle with rate hikes, or at least that's what they're threatening. Will they really do it? Well, if they hate Trump enough, they might do it. So it's going to be very interesting to see how it plays out. And the other factor here is that Janet Yellen, who has been the Treasury Secretary so far, she has been, instead of issuing longer term debt, she's been issuing Treasury bills and shorter term debt. So a lot of that debt is coming due next year, and it falls on the Trump administration to roll over that debt. Now, because of the Fed's rate hike cycle, that debt will now have to be rolled over at a higher interest rate. And it remains to be seen whether they continue the Yellen policy of issuing more T-bills or actually term out the debt and issue more 20, 30-year-old bonds. Now, if they do the 20, 30 bonds, 20, 30-year bonds, then interest rates are going to shoot up. And that's not going to be good for the stock market. That's not going to be good for the dollar. And it remains to be seen whether there is even enough demand to buy that kind of debt. So you don't know. So there are a lot of factors at play which makes the interplay between the new Treasury Secretary and the hostile Fed and Donald Trump's protectionist policies or whatever they are, it's going to be fireworks. So that much is guaranteed. Now, when it's fireworks, what happens to volatility? Volatility goes up. And when volatility goes up, what happens to stocks? They go down. So you don't really have to overthink it. You don't really have to look at valuations. You don't have to look at whether or not there's going to be a ton of profit taking in January. You don't have to look at any of that. You can just go straight from bonds to rates to Powell to Treasury Secretary to figure out that yes, we are going to have a lot of volatility and position for it. And the way to position for it, to me, it comes back to being long commodities. Now, whatever happens, you get a deflationary shock, equities go down. None of that stuff matters. End of the day, commodities are going up. Whether we have a one more down leg first, which I think is not likely or not, I think commodities are going to go up, and that's how I'm positioned. So let me pass it on to you. So let's talk about how you're positioning for this.
Yeah, a lot to unpack there. The one thing I also want to ask you too is, just passing it to you, me looking and watching the repo market. I want to know what your thoughts are. My thoughts are QT is probably over. So I want to ask you, do you think QT is possibly over at this point, meaning quantitative tightening, for people who don't know that? So, explain, a little bit about QT and then just kind of give your view. Do you think I'm right? And do you think it's possibly over coming up soon? Now, once again, I'm not sure if they're announcing that today or in the next 6 months. I'm just saying this year, I'm pretty sure they're going to stop it. So, what's your thoughts on that?
Yeah, so the hard part with the current Fed is that it has become a politically charged institution. So the way Powell is acting, he kind of seems like a madman, and there's no subtle way of putting it. So if their hatred of Trump is so high that they would rather be consumed by hate rather than do the right thing, then probably they continue QT and maybe hike interest rates just when all these treasury bills and all those short term bonds come due, so that the Trump administration has a really hard time running the government. Now, if they do something like that, it's going to be, I cannot tell you what the outcome of something like that would be, because in the Fed's entire 100-year history, that has never happened. So everyone looks at Arthur Burns, William McChesney Martin, and all those guys who fueled inflation and say those are the idiots who destroyed America. But at the same time, they were always puppets of the government. Now, if you have a Fed which comes in and says, I don't like this government, I'm going to be open about it, then maybe QT doesn't end. On the other hand, if sanity prevails and they realize that the good of the dollar, the good of the US government is just printing more money, not caring about inflation, because end of the day, all the Fed does is print money. That's its only function. So if they just continue doing that, then QT ends. And I'm not really sure the way this is going to play out, because I see both arguments have equal merit. The Fed is going to want to project its independence, and therefore it's going to continue QT and hiking rates. The Fed is going to do what all the PhD economists and pretty much every mainstream economist would tell them is the right thing to do, which is end QT, do some form of yield curve control, get back to buying bonds so that the treasury can continue financing itself. So I think the right course to take would be to just let inflation run, because at this point there is no stopping it. So at least you can save the government's finances and maybe save the dollar. So I don't know if they would do that. I expect they might do that, but we'll see. And this is a question that I just can't I just can't answer, because I don't think anyone can answer. I think this is a question that's going to be hotly debated at every FOMC meeting.
No, I agree. It's a tough one. It's just for me looking at it structurally, it's going to make sense for them to have to do it, right? And once again, like you said, like looking at it in the other direction, like they've become very political. And as you become very political, things change very quickly, and you can't act rationally for anything. And I'm not saying like the Fed ever really acts very rationally. That's kind of a ridiculous thing to think as well. I'm just saying that is possible. But I wanted to bring that up because you brought this up, and I just thought this video was funny for those of
The
you.
president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
You know what? I'm not leaving. I'm not leaving. I'm not fucking leaving!
But that's kind of the same thing I think about every single time that subject is brought up, because it's hilarious to kind of think about the way the Fed has worked all these years, and so many people go, it's rational, or they did this good job, or they give them credit for everything good. They don't give them credit for anything bad. It's absolutely ridiculous, but it's kind of funny how politically charged it has gotten lately. So that's something to keep in mind and keep watching in 2025, just to see how they react. A couple other things I wanted to talk about. One thing that's, like you said, talking about commodities here. And the thing that has stuck out to me and just keeps slapping me in the face, and granted, I just went over this in another video, so my subscribers, I'm sorry you have to hear me talk about this again, but I can't stop talking about it, which is this rollover here. The commodities against stocks. So the NYSE line, which is the broad New York Stock Exchange against commodities, that's rolling over. If you look at the bottom of the chart, the blue line, that's bonds against commodities, that's rolling over. And as these things are kind of continuing to roll over and just looking at the action that happened last month, we were just talking about it earlier, oil up 8%, with the stock market down. Basically, the only stock market I think that was up last month was the Japan. Japan was like barely up last month, and everything else was down. The Russell got killed. The Nasdaq was kind of flattish, down just a little bit. But if we look at that and just kind of go into, okay, what are commodities doing here in a time when it didn't make a ton of sense for them to really be really strong right here? I'm just talking about regular analyst, media, TV. None of them would have thought commodities were going to be the ones to win December 24 in an election year. Like nobody would have thought the commodities would have won that, but they did. And just kind of looking at this, it's kind of interesting to keep talking about this, because I think these charts like this, intermarket analysis charts, I think everybody should have in their chart deck ready to look at any time, because it tells you so much about where the market is heading. This is the next one. Now, this is actually even higher today. Now that I continue to look at this chart, we keep breaking out of this pennant pattern, and a pennant pattern is basically a flag pattern that kind of turns to a triangle. We're seeing that breaking out to the upside, kind of continuing this move against bonds in the commodity market. And it's consolidated for a long time. Now, if we break out of that consolidation and move up, that's really saying something. That's telling us that most likely the commodities move is here. But, the reasons behind that, fundamentally, a lot of people are continuing this, hey, it's not exactly it yet. Hey, it's not the time. Yes, commodities look okay, but fundamentally it's this, it's that. But we also see the news coming out from areas like did you see that news on Saudi Arabia today, Kashab?
No, I must understand. What was it?
So let me find it. I clipped it. I just read it a couple hours ago. So okay, I'm gonna bring it up for everybody. So Middle Eastern crude prices surge as supply from Iran and Russia falls. So if you go look at the Saudi Arabian crude prices, like the chart is just going parabolic over the last couple weeks. And once again, it's because of all of the tensions in the Middle East at the moment. And these things continue to come up. So it's like we have the catalysts are all here, right? Now, once again, it's how's the money supply going to look? What's the Fed going to do? We could always debate that. The dollar is very strong. That's another thing that is kind of a negative for oil. Lately, it's been a positive. I don't think that's going to last forever, but that's kind of a negative for oil. But all the catalysts are here for a big move in oil. As long as kind of the Fed continues that direction, I think that commodity prices are going to probably continue to move higher. Look at natural gas. We overlook natural gas. Andy brought up the other day in the group that natural gas is a big weighting in the CPI. So it does put pressure on the CPI prices. So once again, we have all of these things that are kind of saying inflation is probably moving higher, and then it also comes down to how's the Fed going to react to that. Is the Fed going to say, hey, we're done lowering rates, we're going to start holding them steady, we're going to raise them? I'd be very surprised to see them raise rates. So I just think if they're done with QT, I think the commodity cycle is absolutely going to really take off. Another one I wanted to bring up here with you on here, which is this one. So this is the Dow to crude oil. And I always bring this chart up as a very clear level where things are kind of getting out of whack to a point where you kind of want to start taking a look at commodities. That's that blue line. So the blue line, basically, we're kind of getting into these areas. And, some people would call it overbought. I hate that term. Just to me, that's the zone where I want to start looking for a possible reversal. It literally hit that zone, reversed lower. That started in November, now getting into December, now into January. We're still seeing that still move lower. So once again here, I think it's a very important time to take a look at the commodities market. Start learning how to trade futures. I've said this a million times before. I know I'm probably like just saying these things over and over again. It probably sounds ridiculous to some people, but I promise you, you want to be involved in the futures market. I said this back in 2020. Not a lot of people listen to me, only a few. I'm sure they're happy they did. Today, it's the same thing. You want to start taking a look at the futures market. One more thing, crude oil. So here's a chart, and everybody who knows me knows I love these band squeeze patterns. I absolutely love band squeezes, and not because I love them because they're really cool or something. I love them because they work. Probabilities are very high once you see a good band squeeze to levels that we haven't seen in a few years. Like that's basically, we haven't seen that level of a band squeeze since 2020. And that was the move that took oil from under $40 all the way to $130 a barrel. So getting all the way back up there, I don't know, once again, but I think this is a good point to start thinking, I want to be a buyer of oil. I don't know about the equities themselves, but oil itself looks pretty good. So your thoughts on the energy market, do you see anything in the energy market that you would want to start looking into, whether it's uranium, shippers? I know you cover that whole space. So anything that you're thinking of.
Sure. So that's a long topic, energy. So before that, I just want to add one point. So Jason talks a lot about learning to trade futures. I took his advice around 2.5 years back and started doing that. But here's the thing. So futures does not mean leverage. You can have a fully collateralized futures portfolio if you just want to get done with the leverage and just want exposure to the commodities. So that's one way of doing it. It's not like just because you can trade a $200,000 bond contract with a $4,000 account doesn't mean you have to do it that way. In fact, you're probably better off not doing it that way. So maybe you don't trade a $200,000 contract with anything less than a $100,000 account. So there are a lot of ways to trade futures without risking blowing up. So I think that's something people should look into. And if you don't really want to trade the futures, you have ETFs on almost all of these products. So soybeans, there's an ETF. Sugar, there's an ETF. I'm not sure about coffee, but wheat has an ETF. So plenty of those ETFs are available if you want to trade futures that way. So yeah, so getting to energy. I like energy across the spectrum. So all the way from oil E&Ps to the onshore drilling companies, to the offshore drilling companies, to the LNG players, you name it, across the lot. So I like that entire space. And one of our shows, we talked about next decade being the next Trump trade, and it almost hit a new 52-week high today. So we are kind of getting there where everyone's starting to focus back on LNG. And my biggest position, which I've been talking about for a long time now, starting from October, is New Fortress Energy. I think I'm up something around 61% on that stock. And I've been very public about it being my biggest position during this entire run up. So the energy space, if you know where to look, you can make a lot of money in these equities. So where am I looking? So I'm looking at the oil E&Ps. I don't own too many of those, which is the producing oil companies. I don't own too many of those, just a select few. I'm looking at the offshore drillers. Again, I just own a couple of them, not too many. I'm looking at onshore drillers. I own a couple of them. And I'm looking at LNG. I own one stock in that space. And I own shipping. So shipping is the most downstream of the. So I don't own the refiners, and that's because I think Phillips 66. I tried owning Phillips 66, and they had a lot of problems in Q3. and now they kind of have their battles going on in California. So it's a bit of a mess there. And the valuations are really good if you want to own something like HF Sinclair, but I really don't know when that particular part of the oil market will recover. I don't own the MLPs because I'm not in the US and the tax situation is a mess. But the MLPs, that is the pipelines, those have been the best performing stocks in the energy sector in 2024. So everyone says investors are given up on dividends, but if you look at MLPs, they are telling you a different story. So if you are a US investor, then I suggest looking at the MLPs because this is a perfect time to buy those stocks. And what else am I looking at? I'm looking at shipping. So shipping, I'm looking at the product tankers and I'm looking at the dry bulk stocks. So why am I looking at the product tankers? I'm looking at the product tankers because the Red Sea is closed off, and that means longer voyages because they have to go around Africa. And these smaller ships going around Africa, that's harder for them than for the VLCCs, that is the crude carriers, which are used to going around Africa. So this adds a lot of pressure on the fleet, which leads to higher rates. So I'm looking at the product tanker segment. And there's another reason where there's a structural tailwind for the product tankers, and that is the rise of the mega refineries. So India has a mega refinery, Nigeria has a mega refinery. So the refining landscape, it's changed from having a lot of small refineries, the so-called teapots, to having these mega refineries which have scale. So when you have these mega refineries, what happens is you have bigger demand on transportation and lower demand on the upstream side, which is the transport of crude to the refiners. Because now you have these big refiners which are mostly located either in the consuming countries like India or producing countries like Nigeria and Saudi Arabia, and they just transport to the end markets, different from the previous scenario where you had multiple refineries closer to the end markets, and so the transport would be more of crude and less of the refined product. So I'm not sure if I'm explaining it right, but I hope you get it. So that's why I'm looking at the product tankers, and I'm looking at dry bulk because that sector got so beaten down on worries about China because dry bulk is bauxite, it's soybeans, it's coal, it's all the stuff that China consumes. And everyone thought, oh, China is going to have some scary deflation. Their bond yields are falling. The demand for commodities is going to fall off a cliff. Let's sell dry bulk stocks. And it just got so overdone that I think it's going to bounce. And I don't know if it's going to be a structural long term move or a short term move, but I expect that uh, in my entire portfolio, I think the dry bulk stocks will perform the best overall among all the sectors. So that's how bullish I am on dry bulk.
No, I think that's when we're thinking about energy, I think too many people, it's kind of like, you talk about energy, and I think so many people think of it much as a much smaller sector than it really is. It is everywhere. It runs the world. It is in shippers, uranium, utilities, just across the board. If you study energy, you understand that there's trades all over the place in all of these different sectors in all these different countries. Some countries' currencies are commodity-based currencies. Some countries are commodity-based countries. But the one thing, I wanted to bring up, we keep talking about the commodities, and this was taken right at the end of the year. This is just the 1 month performance for December. 33% for natural gas, cocoa up 20. We got crude oil up 5.5. The VIX was also up. Heating oils up 5%. Corn. So this is just a 1 month performance of all this outperformance. The only thing that was up in that month was the Nikkei that was equity based. And what we're seeing too is, the one thing that keeps coming up, and it's a question that we should talk about here because everybody keeps bringing it up. Gold, the dollar, oil, all together, the last few days have just kind of continued to move higher. Do we think that's sustainable? It's a question that, I know a lot of people have. I'd love to pass it to you first. What do you think? Is that a sustainable thing? Do you think it reverses? Do you think the correlation is changed now because of some event? Feel free to answer.
Sure. So I think the dollar's done, and it's going to have a long-term bear market. So think of what happened in the 70s. So you want to own currencies like the Brazilian real and the South African rand, currencies that you would never even consider looking at, because you look at the country and you think they have so many problems. Why would I want to own their currency? And I think we are getting to that stage where you sell the dollar to buy all those currencies. Now, I'm not saying you go buy the Turkish lira or the Lebanese currency, which is, they have capital controls and all kinds of issues. So I'm not saying you buy those currencies, but like the real, the kiwi, the Chilean peso, things like that. So I think the dollar is done, and you should forget about looking at the dollar in euro terms, because the euro is also kind of done. So look at dollar and euro versus all these other pairs, the kind of exotic currencies you wouldn't even think of owning. And I think dollar has peaked. Now, coming to gold and oil, usually you would see either oil doing really well or gold doing really well. So they tend to kind of have an inverse relationship. But I think that inverse relationship is closer to it's only true that they have an inverse relationship when there's a turning point. Meaning when gold has peaked, you'll start to see oil going higher, or when oil has peaked, you'll start to see gold picking up. It's only at those turning points that you see that inverse. So I think we are at the starting point where both of them can go up at the same time. It's something similar to what we saw around 2017 or 2019, I would say, where gold and the dollar went up together at the same time. Now, usually you wouldn't expect that to happen, but it did. Or you can see gold start to rise while bond yields rise, which is what we saw last year. So I think these relationships hold over the long term, but it's a mistake to take that relationship and think there is no trade which goes counter to these correlations, because I think it is possible to have multi-month trades which go counter to these correlations, and we are at that point now.
No, I think that's well said. And if we look at the dollar chart, even, for me, it's so many people were, asking the other day, where do I think it's going to go? Once again, if I'm just taking it based on my macro models, which would say this is extremely overvalued, and basically we use economic data and global interest rates. So using economic data, global interest rates, understanding that this is a problem already. Like the dollar up here is a problem. Let's be honest. Not a problem to you or me. It's definitely a problem to the United States. It's a problem to globally, and so keeping it up here just doesn't make any sense for anybody. The only reason why it would stay up here is if it completely got out of everybody's control, and that's possible. It's the one thing that can't happen. But I'm also with you on. I think that the Fed kind of came in and signaled, as they normally do first. They signal, hey, we're going to start slowing down on our rate hikes. Our rate cuts. So as they're slowing down on their rate cuts, then the rest of the world is still cutting, supposedly. The next thing you know, we're going to see them start to say, okay, well, now we're going to start slowing down on our rate cuts. And that's what usually starts to make the dollar top in these type of scenarios. So I think there's a lot of reasons here to just think, hey, the dollar is moving up. I'm not going to front run it. I'm not going to get ahead of it. I'm not going to start trying to short it right here by any means, but I am looking for it to top out any day now over the next month to month and a half. I think the commodities are kind of signaling that as well. And if we look at all the intermarket analysis, the pressure put on the economy from yields, all of these things together, the possibility of ending QT, the way the repo market looks, going from under 100 billion to 500 billion the last time I looked, seeing those types of moves, I definitely think the dollar is probably going to reverse lower here. and maybe not today, maybe not tomorrow, maybe it takes a couple months. My time frame's pretty long term for most things, but getting back to those old highs, hitting 115 again, I would be really surprised. And if that does happen, it's the other thing that needs to be said. If that does happen, the market is going to see some major pain. Like that's not going to be a situation where you can run to some specific sector. Like that's a big deflationary shock. And if the idea is to create a soft landing, um, that's just going to completely get in the way of it. So I don't think it's in anybody's interest, who has any control over the money supply, to let the dollar just continue to rage higher here. Um, so yeah, let's talk about food inflation. Um, so, what are you thinking about food inflation? I will try to find a chart of palm oil. I don't know if I have a chart on this for it, but let's look. I'll look for it, and then we can kind of get to that. But yeah, let's talk about food inflation. What you're seeing out there, and I'd like to hear like your. I love to hear stories from people and anybody who's on in comments. Like if you're in a different area, a different country, feel free to write in and say like what you're seeing inflation wise. I love to get that feedback because that really tells me a lot. Because sometimes in the United States, people are completely oblivious to certain things, and then at the same time in other areas, people are very aware of it. So please write in, say whatever. So, anyways, so what are you thinking, Kashab? What are you want to talk about here?
Yeah. So I mean, everyone knows coffee is running. Everyone knows cocoa is running, and it looks like the cocoa situation is only getting worse from here. And finally, I think after 6, 7 months of waiting, we are seeing corn taking off. Wheat not quite as much yet. Sugar still stuck, but I think this is the place where it all turns. And when it all turns, you're going to see food inflation coming back. And I wanted to bring up palm oil because we talk about all these agriculture commodities, and those are traded in the US, but palm oil is traded in Malaysia. Not many people know about it. But for pretty much, let's say, 4 or 5 billion people of the world's population, that's the most important price because that's the only oil that you can actually get access to. And when you see palm oil prices running, that's really, really scary because that's the kind of run that causes revolution. So we all remember the Arab Spring and all the turmoil in the Middle East around that time. And what was it caused by? Food inflation. So um, in the developed world, we talked about food inflation and we say things like, yeah, you go to the supermarket, goods are more expensive. But then there's the other scary part of food inflation, which is what happens in the developing world when you have these issues. So India, they wanted to get ahead of it by banning rice exports. And they completely killed the commodity market. So every once in a while, India goes through this phase where they ban trading in agricultural futures because they think keeping the evil speculators out of the market is what will bring prices down. And they are kind of in that ban phase now. So a lot of stuff happening, and I don't really have too many insights to share. I just thought it would be something fun to bring up and maybe give it to our audience to add their comments.
Yeah, so the one thing about palm oil and food oils in general. So as you said, most people in the United States who don't trade these products and don't understand them, just kind of glance over it and don't think it's very important. I do because I also know how much of this is actually used globally. And also, if you just look at inflation, like when did it like if you're looking at CPI, all this stuff, like sure you could have arguments about whatever. But if you're looking at the actual commodity prices and when they started to move and when they stopped moving, look at palm oil. Palm oil literally bottomed in March 2020. It literally topped in April 2020. So all the commodities moved in a huge way that whole time, and palm oil really led the way. That's a really big move for any market, especially a commodity market, which puts a lot of pressure on it. So basically, we're talking about from 2,000 all the way to 7,000. That's a huge move in palm oil. And you'll see this in the seed oils first. Like canola oil has been running too lately. And yes, it's nowhere near, these levels that we're looking at right now in palm oil, but it's starting to move. And people don't understand. Like, it's kind of like when you look at inflation and I say, hey guys, services inflation is really ticking up here, and that's going to move into other areas. And people just go, well, that has nothing to do with anything else. Like, it's all connected. It absolutely is all connected. So if we're looking at palm oil, we're seeing palm oil start to move. And then next thing you know, we're seeing oil this month, last month, and this month starting to move like crazy. And then we continue to move forward and see this commodities to bonds ratio starting to move higher. Then we see the stocks to commodities ratio starting to move. As all of these are moving that direction, that just means, one, I think that this is without even saying, but the long bonds, I would stay the hell away. Everybody keeps telling me, hey, they're bottoming here. Hey, this is about to happen. Sure, anything's possible. I'm not saying it's impossible for bonds to make a bounce here. They probably will. Sure. But if you're a long-term investor and you're a long-term swing trader, long-term position trader, holding retirement accounts, stay the hell away from bonds. And Kashop, you remember, I was very vocal about this all the way back in 2020. The bond market is dead. I literally called it on the day. Like March 2020, I literally called it on the day and said that was the spike top that we were going to see for probably many years. Now, once again, do I know that 100% going forward? No, I can't read the future. But it seemed like with the Fed action, with all the free money that was going to be out there, with inflation starting to take off, that seemed like the point of change. Not to mention bonds are on a 40-year cycle. That was around the 40-year zone, 1982 to 2020. It made a lot of sense that it reversed. It hasn't even had a year. Like, this is another year of the bonds being down. That's 4 years in a row. I don't know if that's actually happened in history. I have to go back to the 70s to kind of take a look and see if that has happened before. But 4 years in a row, that's pretty wild. So I think the one thing that I want to continue to say is stay the hell away from bonds, especially long bonds, not short dated bonds. Nothing wrong with short dated bonds. You're riding them, great. Especially the Eurodollar futures, which are the name is now changed, but I'm always going to still call them that, meaning the 3-month bonds that's tied to the Fed rate. That's still working out really well. Continue to be long that. However, the rest of the bond market, I would kind of say, hey, I'd rather be on the short side. Mainly because of the food inflation. It's not going away.
So I was looking at the State Street ETFs. So they have these target maturity bond ETFs, meaning you can buy a ETF which owns bonds that mature in 2029. So end of 2029, you get your principal back. The ETF gets shut down and you get all your money back, right? So I was looking at the yields on those structured products, and it's not even 4%. And these are not just ETFs owning treasuries, these are ETFs owning corporate bonds as well. So they have terrible yield, and you're locking up your capital all the way to 2029, 2030 for like 4%. Do you really think inflation will not be more than 4% consistently during that entire duration? So I think even if we have had 4 consecutive years of negative returns in bonds, as long as investors' expectations aren't reset, we can have 4 more. There is really no end to it. Like, you remember the last decade where things got so crazy that Nestle was issuing bonds at a negative yield. Austria was issuing 100-year bonds. Argentina was issuing 100-year bonds in US dollars. It was so crazy. And just when we thought it couldn't get even crazier, it did. So if you look at German bonds from 2015 to 2020, the yield just kept getting lower on a yearly basis. And it was just unfathomable, but it happened. And why did it happen? Because insurance companies were buying negative yielding bonds, because the ECB was buying negative yielding bonds. So when something which is a historic anomaly of that sort reverses, I think we can get an anomaly on the other extreme wherein it reverses and it reverses hard and it just keeps going. So I think we are in the start of that. So I echo a message: stay the hell away from long dated bonds. If you must, buy the short term and try to buy some high yielding securities in the commodity space. Try to buy preferred shares. So you can buy a lot of preferred shares in the shipping space. You can buy a lot of the bonds of the commodity producers. So I was looking at New Fortress Energy. They had a 14% yielding bond. Now, that's a bet I would take because I understand the credit risk and it's a fat yield for taking that credit risk. Whereas buy treasuries, which are 10, 20 years maturity, no, I would just stay away from that. I think you're on mute.
Thank you. And we'll just end on this. I was just talking about bonds being on a 40-year cycle. Granted, this chart isn't as far back as I exactly wanted to go. I just was trying to grab something on the fly. The that service that I used there, it only went back this far as well. I don't know what's going on with that right now. But just looking at that long-term trend, and this is what I want to bring up when we talk about our parents and them being able to put money away and kind of buy and hold for the last 40 years. Part of the reason why they could do things like that with retirement accounts is just because bond yields went down for 40 years. You take a 60-40 portfolio, your bad years, bonds are going up when stocks are going down. Your good years when stocks are majorly outperforming, you're yielding a decent return. So, you can continue to do that year after year for many, many years and your portfolio looks good. But what if this changes? And this is what I'm mainly kind of getting at here. What if this is a 40-year uptrend in bonds? Yes, I'm not saying there won't be corrective rallies down. But just thinking that, the Fed rate's going to get back to zero anytime soon would be very surprising to me. Just thinking that we're not going to just move higher and one day be at a point where we're around 10% and going, well, maybe we need to change this a little bit. Maybe maybe something's going on here. And one day maybe we hit another spike top the other direction in the next 10, 20. Now, once again, I don't know if everything's going to be on a perfect 40-year cycle forever going forwards. But I am saying that this is structurally a bullish period for yields, meaning a bad period for bond prices. So I would continue to kind of look at that and go, I want to stay away from this whole long bond idea at the moment. I'm interested in some short dated bonds. I should probably learn how to trade the futures market, considering from the 30s all the way to the 80s. That was a really good time to understand how to trade the futures markets. There was a lot of good trades in that time, and not to mention the 70s were absolutely insane for trading like that. So inflation is good for commodities traders, not very good for everybody else. But the idea here is to protect our money. Somebody asked me that the other day. We're going to cover it on Monday next week. How do we protect our money if oil prices are moving up, if inflation continues to get out of control? And the idea here is to kind of tell you guys how we're protecting our money, whether it's using stocks, whether it's using bonds at certain periods of times. Everybody thinks I'm a crazy bond bear. When Kashat met me, I was the crazy bond bull. It changes over time. Whatever is going to protect our money is kind of the thing we have to do. And the idea here is teaching other people how to protect their own money, protect their currency, take care of their families, and enrich their lives. And that's why I love doing this. So once again, I want to thank Kashat for coming on today. Thank you guys for hanging out with us. For those of you who were in our group channel yesterday, I apologize. I didn't know so many people were going to show up, so some people got locked out. I fixed that. I upgraded our account, so everybody will be in on the next one. And we'll see you guys soon.
Bye, everyone.